I am Jesse Livermore, the man Wall Street feared and respected in equal measure. I made and lost several fortunes in my trading career, but perhaps my most legendary move was when I made 3 million dostos in a single day, shorting the market during the 1907 panic. That's equivalent to about $90 million in today's money, all from reading the market's true intentions. Let me share how I orchestrated this trade. I didn't rely on tips or rumors. I trusted only the market's action. In the months before October 1907, I observed troubling patterns that others ignored. The market was sending clear warning signals, declining volume on rallies, increasing volume on drops, and leaders failing to make new highs. I had developed what I call my pivot point system. I identified key price levels where the market would either confirm or deny its direction. When Union Pacific broke below its support level with unusual volume, I didn't hesitate. I added heavily to my short positions. My approach was methodical, not emotional. I had already established small short positions in the market's weakest stocks. I always test the market with smaller positions first, what I call probing the line. This allows me to confirm my theory with minimal risk before committing significant capital. As panic selling accelerated that October, I maintained ice-cold discipline. While others frantically liquidated positions, I systematically increased my shorts at each new low. The market was confirming my thesis with every tick lower. When the banking system began to crack, I knew we were headed for a full collapse. My trading journal from that period shows my exact thinking. Market internals deteriorating. Banks calling loans. Pyramiding shorts on each new low. I remained objective when everyone else succumbed to emotion. The crucial element of my success was patience. I had built my position over weeks, not days. I didn't try to catch the exact top. I waited for clear confirmation that the trend had changed. When the evidence became overwhelming, I acted with conviction and size. By the time the market crashed on October 24th, I was positioned perfectly. As stocks plummeted, my profits soared. I covered my shorts systematically on the way down, taking $3 million in profits in a single session. What separated me from others was my willingness to act on what the market was telling me, not what I hoped it would do. I didn't fight the tape. When the market spoke, I listened. Remember this. The market will tell you everything you need to know if you're willing to listen. Most traders fail because they impose their wishes on the market rather than responding to what is actually happening. My success that day wasn't luck. It was the culmination of years studying market behavior and developing the discipline to act decisively when opportunity presented itself. The market rewards those who can read its true intentions and act without hesitation. I've given you the framework I used to make millions in a single day. The principles remain unchanged a century later. Test your thesis with small positions, add when confirmed, and act with conviction when the evidence is clear. The market will always reward those who truly understand its language. I am Jesse Livermore, and I made and lost more fortunes than most traders will ever see in a lifetime. My first million came before I turned 30, and I walked away with $100 million after the 1929 crash, about $1.5 billion in today's money. How? By mastering what I call pivot points in price action. This isn't some modern technical indicator. This is the foundation of market movement I discovered through decades of painful lessons. Let me teach you my pivot point system. I developed this after losing everything, twice, and realizing the market leaves footprints if you know where to look. When I watch price action, I'm looking for one thing: the point where supply and demand truly clash. I call these pivot points. These aren't arbitrary support and resistance lines that amateurs draw. My pivot points emerge when the market tests a level multiple times and fails to break through. Each test tells me something critical about underlying strength. In 1907, I watched U.S. steel repeatedly test the $50 level. Most traders saw random fluctuations. I saw a battle between buyers and sellers. When it finally broke below after the third test, I went short with everything I had. The stock collapsed to $8, and I walked away with millions while others were ruined. Here's exactly how I identify my pivot points. First, I watch for a stock to make a significant high or low, one that stands out on the chart. Then I wait patiently as the market tests this level again. The second test is crucial. If prices approach but don't quite reach the previous extreme, that's my first signal. When this happens a third time, I prepare to act. The key insight I discovered after years of trading: it's not the price itself that matters, but how the market behaves at these levels. I look for volume to dry up as we approach previous pivot points. This tells me the other side is weakening. When I see this pattern, I position myself accordingly and wait for the inevitable break. I don't use complicated indicators or systems. The market doesn't care about your fancy mathematics. I use only price and volume, the purest expressions of market psychology. Everything else is noise designed to separate you from your money. During the 1929 crash, I noticed the market making lower pivot points on each rally attempt. While others bought the dips, convinced the bull market would resume, I saw the deterioration in these pivots. Each rally failed at a lower level than the previous one. I shorted heavily and made $100 million when the market collapsed. Remember this: pivot points work because human nature never changes. Fear, greed, and the herd mentality create these patterns over and over. I've seen it in Union Pacific in 1906, in wheat in 1925, and you'll see it in whatever you trade today. My pivot point strategy isn't just about identifying levels. It's about understanding the psychology behind them. When a level holds 3 times, traders develop confidence in it. When it finally breaks, that confidence shatters, creating the explosive moves I built my fortune on. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. Today, I'm going to reveal my second most powerful secret, the volume spread analysis method that helped me amass millions when others were losing everything. Volume spread analysis became my edge during the panic of 1907. While others were blindly selling, I was reading the tape differently. I wasn't just looking at price. I was studying the relationship between price movement and volume. This is what separated me from the amateurs. Let me explain exactly how I use volume spread analysis. When I see a wide range price bar with exceptionally high volume but minimal price movement, I recognize professional money at work. The big players are absorbing all the selling. This is what I call a stopping volume pattern, and it signals a potential market bottom. I've used this to enter positions just as markets were about to reverse, while everyone else was still panicking. During the 1929 crash, I spotted multiple stopping volume patterns. On Black Thursday, I observed enormous volume, yet prices closed well off their lows. The professionals were buying into the panic. I went long the following Monday and caught a substantial rally. The masses thought I was insane, but I trusted what the volume was telling me. I look for 3 specific volume patterns that have made me millions. First, I identify effort versus result imbalances. When I see massive volume, effort, but minimal price movement, result, I know someone powerful is absorbing all the buying or selling pressure. In 1923, I spotted this pattern in wheat futures. While everyone saw chaos, I saw accumulation. I bought heavily and doubled my money in 6 weeks. Second, I watch for climactic volume. When everyone is selling in panic and volume spikes to extreme levels, I get ready to buy. The professionals are quietly taking the other side of those trades. I made one of my largest fortunes by buying into the 1921 market panic precisely this way. Third, I identify no demand situations. When prices try to rally but volume decreases, I know the rally lacks conviction. This is my signal to sell, or short. I used this to short overvalued stocks throughout 1928, building my war chest for bigger opportunities. The beauty of volume spread analysis is that it shows me what the smart money is doing, not what they're saying. In 1908, all the newspapers were bearish on Union Pacific, but I saw massive accumulation in the volume patterns. I bought heavily against public opinion and rode it up for a 40% gain. Remember this, price can lie, but volume rarely does. When I combine price action with volume analysis, I see exactly what the professionals are doing with their money. They leave footprints in the market that most traders never notice. I've given you one of my most valuable tools. Most will ignore it because it requires patience and discipline, qualities in short supply on Wall Street. But for those who master volume spread analysis as I have, the rewards are extraordinary. The market will always reveal its intentions to those who know how to listen. I'm Jesse Livermore, and throughout my trading career, I developed what I call the pivotal point confirmation system. This is perhaps my most powerful secret, and I've used it to make millions in the market while others were losing everything. Let me explain exactly how I use it and how you can apply it too. When I look at a chart, I don't just see lines and candles. I see battlefield terrain. I see where the armies of bulls and bears have clashed, where they've retreated, and most importantly, where the next decisive battle will be fought. These are what I call pivotal points. A pivotal point is simply a price level where the market has shown significant reaction in the past. I look for these levels religiously because the market has memory. When price approaches a level where it previously reversed, I pay extremely close attention. But, and this is critical, I never act on the pivotal point alone. I wait for confirmation. Here's my exact process. First, I identify key pivotal points on the chart, previous major highs, lows, or areas where price consolidated for extended periods. I mark these levels precisely. Then I wait patiently for price to approach one of these levels again. This is where most traders make fatal mistakes. They assume history will automatically repeat and enter positions prematurely. I don't do that. Instead, I watch how the market behaves when it reaches the pivotal point. I'm looking for confirmation, a specific price action that tells me the level will hold or break. For a support level to be confirmed, I need to see buyers step in with volume and price form a recognizable pattern, perhaps a hammer candle or a double bottom. For resistance, I look for rejection candles, bearish engulfing patterns, or failure to make new highs. In 1907, I used this exact system during the banking panic. While others were blindly selling in panic, I identified a major support level that had held 3 times before. When the market approached it again, I didn't immediately buy. I waited. The market tested the level, showed strong buying volume, and formed a reversal pattern. Only then did I enter, accumulating a massive position that made me millions when the market recovered. The confirmation is what separates speculation from calculated risk. Without confirmation, you're simply guessing. With it, you're trading with the odds significantly in your favor. I've refined this system through decades of trading. The key components are patience, precision, and the fourth, discipline to wait for confirmation. Most traders can identify pivotal points, but they lack the restraint to wait for the market to show its hand. Remember this: pivotal points are where battles are fought, but confirmation tells you who's winning the war. I never enter a trade without both elements in place. This isn't just a strategy. It's the cornerstone of my entire trading approach. It's how I've survived and thrived through panics, crashes, and bull markets alike. Master the system, and you'll have an edge that most traders will never possess. The market will always tell you what it intends to do, but only if you know how to listen. I've spent my life learning this language, and now I've shared it with you. I am Jesse Livermore, and today I'm revealing my pivot line method, the most powerful market reversal indicator I developed throughout my trading career. This isn't some theoretical concept taught in books. This is the exact methodology that helped me accumulate over $100 million in today's dollars and predict major market turns that baffled Wall Street. When I first discovered the power of pivot points in the early 1900s, I kept it closely guarded. Why? Because I knew this approach gave me an edge that others simply didn't have. I've used this method to anticipate the 1907 market crash and the 1929 collapse, making millions while others lost everything. Here's exactly how my pivot line method works. I identify key price levels where the market has shown significant resistance or support in the past. These aren't arbitrary numbers. They're psychological barriers where buyers and sellers have previously engaged in fierce battles. When price approaches these levels again, I watch intently for confirmation signals. My method requires patience and discipline. I don't simply buy or sell when price touches a pivot line. Instead, I wait for what I call a price commitment. When the market shows its hand by decisively breaking through or bouncing off these levels with increased volume. This confirmation is critical to my success. Let me give you a specific example from my own trading. In 1907, I observed that U.S. steel repeatedly failed to break above a certain price level. Each rejection was followed by increasing selling pressure. When I saw this pattern forming at a major pivot line, I took a substantial short position. The stock collapsed soon after, and I walked away with $1 million in profit, equivalent to about $30 million today. I've learned through painful experience that pivot lines aren't static. They evolve with market conditions. What served as resistance yesterday may become support tomorrow. I always adjust my pivot lines based on recent price action and never cling to outdated levels. The market is always right, and I follow its lead. One critical aspect of my method is scale. I use pivot lines across multiple time frames, daily, weekly, and monthly charts. When I see alignment across these time frames, I know I've found a significant opportunity. The convergence of pivot lines creates what I call confluence zones, areas where market reversals are highly probable. My pivot line analysis isn't just about price. I incorporate volume as well. When price approaches a pivot line with declining volume, I know the move lacks conviction. But when I see expanding volume at these critical junctures, I prepare to act decisively. Volume confirms price always. I've paid dearly for ignoring my own pivot line signals. In 1915, I disregarded a clear pivot line reversal and held onto my positions, resulting in substantial losses. I learned that no trader, not even myself, is above the market. When my pivot lines signal a change in trend, I respect that message regardless of my personal opinions. Remember this, pivot lines aren't magical. They're manifestations of human psychology playing out in the markets. Fear, greed, and uncertainty create these recurring patterns. By respecting pivot lines, I'm not predicting the future. I'm simply recognizing how market participants repeatedly behave at critical price levels. Master this method, and you'll see the market through my eyes. I am Jesse Livermore, and I've made and lost more fortunes than most traders will see in 10 lifetimes. Today, I'm revealing my third and perhaps most powerful secret: volume spread analysis, the hidden footprints that market manipulators leave behind. While others chase headlines and tips, I've spent decades tracking the silent movements of big money. Let me be clear. The market is manipulated. I don't say this as conspiracy. I say this as fact. The difference between amateurs and professionals like myself is that I don't fight this reality. I exploit it. When I made my legendary killing in the 1929 crash, I wasn't guessing. I was reading the volume footprints that smart money left behind. Volume spread analysis, VSA, became my edge. After losing my second fortune, I realized price alone was insufficient. What matters is the relationship between price movement and volume. This reveals intention. When I see a wide-range down bar with ultra-high volume, but the close is near the high, I immediately recognize a buying climax. The smart money is absorbing all the panic selling. I buy when others are terrified. In 1907, I watched J.P. Morgan's men leave these exact footprints before the market reversed. They created panic, absorbed the selling, then drove prices higher. I followed their lead and turned $10,000 into $1 million. The footprints never change because human nature never changes. Here's exactly how I apply VSA. I look for effort versus result. When I see massive volume, effort, but minimal price movement, result, someone powerful is either accumulating or distributing. In 1929, I noticed abnormally high volume on narrow range days near market highs, classic distribution. The big players were selling to the public while newspapers touted a new era. I went short and made $100 million in today's dollars. I pay particular attention to what I call tests. After a significant decline, when price revisits previous support on dramatically reduced volume, I know the selling pressure has dried up. This is my signal to buy. Conversely, after a rally, when price tests resistance on weak volume, I prepare to sell or short. The beauty of VSA is its timelessness. Whether I was trading cotton in 1907 or stocks in 1929, the signatures remained identical. In your modern markets with high-frequency trading, the principles still apply, just at different time frames. My specific rule: I never buy on high-volume up bars late in a trend. That's distribution, smart money selling to fools. Instead, I wait for low-volume pullbacks after signs of accumulation. That's where I made my millions. Remember this: volume precedes price. Always. When I see divergence, price moving one way while volume suggests the opposite, I prepare for reversal. This single insight has saved me from countless traps. I've given you the exact method I used to become the greatest trader of my era. Most will ignore it, preferring the comfort of headlines and tips. But for those who master reading these footprints, the market will never look the same again. The manipulators will unwittingly become your greatest allies. I am Jesse Livermore, and after decades of trading through booms and busts, I've developed timing strategies that have made me millions while others lost everything. Today, I'm sharing one of my most powerful yet underutilized techniques, my 3-day rule. This isn't something you'll find in textbooks. It's a strategy I personally refined through brutal market lessons and spectacular victories. When I look at market movement, I don't just see price action. I see confirmation patterns that separate real moves from false starts. My 3-day rule is simple in concept, but devastatingly effective when applied with discipline. I never take a major position until a market move has confirmed itself across 3 consecutive trading days. Let me explain exactly how I implement this rule. When I spot a potential breakout or breakdown, I don't immediately jump in like amateur traders do. Instead, I wait patiently for 3 consecutive days of price action in the same direction. I need to see the market prove its intentions to me before I commit my capital. During the 1907 panic, I watched as stocks plummeted. While others frantically sold on the first day of the crash, I observed. By the 3rd consecutive down day, I had confirmation this wasn't a temporary dip, but a genuine collapse. I then established my short positions and made over $1 million, equivalent to about $30 million today, because I waited for confirmation while others reacted emotionally. The psychology behind my 3-day rule is profound. I've found that 1 day of movement might be noise, 2 days could be coincidence, but 3 days in the same direction typically represents a genuine shift in market sentiment. I've used this principle to avoid countless false breakouts that would have devastated my capital. When implementing my 3-day rule, I look for 3 specific criteria. First, each day must close in the direction of the trend. Second, volume should generally increase, confirming genuine participation. Third, the price range should be healthy, not exhaustive or diminishing, suggesting continued momentum. I apply this rule differently in various market conditions. In bull markets, I might look for 3 days of higher lows and higher highs before buying. In bear markets, I search for 3 days of lower highs and lower lows before shorting. I've learned that patience is not just a virtue, it's a profitable strategy. The most common mistake I see traders make is confusing patience with hesitation. When I wait 3 days, I'm not hesitating. I'm gathering critical confirmation. Once I have my confirmation, I act decisively and with size. This combination of patience in analysis and aggression in execution has been central to my trading fortune. Remember this: the market will always be there. The 3-day rule forces you to miss the exact bottom or top, and I'm perfectly comfortable with that. I don't need to catch the first 10% or the last 10% of a move. I want the meat in the middle, the 80% where the real money is made with significantly less risk. I developed this rule after losing my fortune multiple times. Each devastating loss taught me that rushing into positions based on 1 day's movement was gambling. not trading. My 3-day rule transformed my approach from speculation to calculated risk management. I am Jesse Livermore, and I've discovered that the market's greatest resistance isn't found on any chart. It exists in your mind. The psychological price barrier is what separates the amateurs from the professionals, the losers from the winners. I've made and lost fortunes multiple times throughout my career, and each time the barrier I needed to break wasn't just a price level on a stock. It was my own mental resistance. When I first started trading, I believed technical analysis alone would make me wealthy. I was wrong. I studied patterns obsessively, but still found myself hesitating at crucial moments. Why? Because I hadn't mastered my own psychology. Let me share what I've learned about breaking through resistance, both on the charts and in your mind. The most powerful resistance levels aren't just numbers. They're emotional thresholds where fear and greed collide. I've watched traders, myself included, freeze at these junctures. I remember shorting Union Pacific in 1906 before the San Francisco earthquake. The stock was clearly weakening, but I hesitated to add to my position because I'd already made substantial profits. That psychological barrier, the fear of losing what I'd gained, prevented me from maximizing my returns. When the earthquake hit and markets collapsed, I profited, but not nearly as much as I should have. Here's my method for breaking through psychological resistance. First, I separate my analysis from my emotions. I develop my trading thesis before I have money on the line, when my judgment isn't clouded by position bias. I write down exactly what would confirm or invalidate my thesis. Second, I use position sizing to manage my psychology. I've learned painfully that oversized positions magnify emotional responses. When I took that massive short position in cotton in 1919, my position was so large that my emotions became unmanageable. I couldn't think clearly. Now I size positions so that no single trade can devastate me. Third, I practice mental rehearsal. Before entering significant trades, I visualize both success and failure. I ask myself, if this trade moves against me, how will I respond? This preparation neutralizes the shock when markets move unexpectedly. Fourth, I've learned to recognize my own patterns of self-sabotage. During my biggest wins in the 1907 panic, I noticed I had a tendency to take profits too early when trades went my way. By recognizing this pattern, I developed rules to let my winners run. The most dangerous resistance isn't on your charts. It's your unwillingness to accept losses, your tendency to hope, your fear of missing out, your greed when you should be cautious, and your fear when you should be bold. Remember this: the market doesn't know you exist. It doesn't care about your hopes or fears. It simply moves according to its own logic. Your job isn't to predict the market. It's to respond to it without the psychological barriers that trap most traders. I've given you the blueprint for breaking through resistance. The question is, do you have the discipline to implement it? The market will test not just your strategy, but your character. And in my experience, character determines results far more than strategy ever will. I am Jesse Livermore, and I'm about to reveal one of my most powerful trading weapons: volume divergence analysis. This method made me millions during the 1907 panic and later market crashes, when I correctly identified major market turning points, while others were blindly following price alone. Volume divergence is deceptively simple, yet devastatingly effective. I discovered this pattern after losing my fortune twice and realizing price movement alone was insufficient. The market speaks through volume first, price second. When I see volume and price telling different stories, I pay attention. That's where the real money is made. Here's exactly how I apply my volume divergence method. I watch for situations where price continues moving in one direction while the volume behavior contradicts it. When prices make new highs, but volume fails to confirm with proportionally higher volume, I prepare for reversal. The smart money is quietly distributing shares while the public still buys enthusiastically. I've witnessed this pattern precede virtually every major market top I've traded. The inverse applies to bottoms. When I see prices making new lows but volume isn't expanding proportionally, I look for accumulation. During the 1907 crash, I noticed trading volume diminishing on downward price movements after weeks of panic. While newspapers screamed disaster, I quietly began buying. The reduced volume told me selling pressure was exhausting itself. I apply 3 specific rules when trading volume divergence. First, I never act on the initial divergence. I wait for confirmation. Second, I look for a divergence that persists across multiple time periods, not just a single day. Third, I combine this with my pivot point analysis. When a stock fails at a previous pivot point with declining volume, that's my signal. The 1929 crash demonstrated this method perfectly. In September 1929, I observed stocks making new highs, while volume was notably weaker than previous advances. The public was still buying, but the smart money, the real market movers, were quietly distributing. I began establishing my short positions, which ultimately made me $100 million when the market collapsed. Remember, volume precedes price. When I see heavy volume on up days followed by light volume on down days, I know accumulation is happening regardless of current price action. Conversely, when I see light volume on up days and heavy volume on down days, distribution is occurring. The market will eventually follow volume. I've found volume divergence particularly powerful at market extremes. At tops, euphoria drives prices higher on increasingly thin volume as fewer large players participate. At bottoms, panic creates high volume sell-offs until eventually down days show diminishing volume, the sign I wait for before buying. My volume divergence method requires patience and discipline. You must train yourself to ignore the noise, news, tips, opinions, and focus on what the market is actually telling you through the relationship between price and volume. I don't predict markets. I listen to them. This method saved me countless times and made me millions when properly applied. It's not about being right every time. It's about recognizing when the odds are significantly in your favor. When price and volume diverge, the odds shift dramatically. That's when I strike. That's when I make the trades that build fortunes. I am Jesse Livermore, and I discovered the pivot point confirmation technique during my most profitable years on Wall Street. This technique became my secret weapon when I made millions shorting the 1929 crash. Let me teach you exactly how I use it to identify major market turning points with extraordinary precision. The pivot point confirmation technique is not something you'll find in typical trading books. I developed this through decades of painful losses and spectacular wins. When I look at any market, I'm searching for what I call pivot zones, price areas where the market psychology fundamentally shifts. Here's precisely how I execute this technique. First, I identify a potential pivot level by watching where large volumes of trading occur at key support or resistance. But, and this is critical, I never enter a position based solely on the price hitting these levels. That's amateur hour, and I've lost fortunes in making that mistake. Instead, I wait for my three-part confirmation signal. When price approaches my predetermined pivot zone, I look for abnormal volume patterns, a specific candlestick formation showing momentum shift, and most importantly, what I call time confirmation. The market's ability to hold above or below the pivot for at least 3 consecutive time periods. I applied this exact technique in early 1929. While most traders were still buying the rallies, I observed my pivot confirmation at 381 on the Dow. The abnormal volume, the evening star candlestick pattern, and the time confirmation all aligned perfectly. I went short with everything I had. The result? I walked away with $100 million in today's dollars when the market collapsed. Let me be crystal clear about something. This technique requires iron discipline. When I see my confirmation, I act decisively regardless of what the newspapers, my friends, or my emotions are telling me. The market doesn't care about your feelings, and neither do I. I've trained myself to execute mechanically once my conditions are met. The most powerful aspect of my pivot point confirmation is that it works across any time frame. I've used it on monthly charts to position for major economic shifts and on daily charts to capture intermediate swings. I've even applied it to hourly charts when I needed to time my entries with surgical precision. One warning I must give you: never confuse normal market noise with a true pivot confirmation. I've seen countless traders mistake routine pullbacks for major reversals. My technique demands patience. Sometimes I'll watch a potential pivot for weeks before getting my confirmation. This patience is what separated me from the amateurs who were wiped out while I prospered. Remember this: the market will test your conviction at every turn. When I shorted in 1929, I endured several sharp rallies that would have shaken out a lesser trader. But my pivot confirmation gave me the conviction to hold my position. Master this technique, and you'll develop what others will call an uncanny ability to time market turns. It's not magic. It's simply the mechanical application of a system I perfected through decades of trading the biggest market moves in history. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. Today, I'm revealing secret number 6, my lost money management formula, the system I developed after losing millions and having to rebuild from scratch multiple times. When I began trading in the bucket shops of Boston at 14 years old, I had no concept of proper money management. I simply bet what I had. This nearly destroyed me several times. By 1940, I had made and lost over $100 million in today's dollars, multiple times. Why? Because I mastered market timing, but failed at managing my capital. Here's the formula I eventually developed but rarely shared. I never risk more than 10% of my trading capital on any single position. But that's just the beginning. I divide my capital into 10 equal portions, but I don't deploy them equally. The first 10% goes into my highest conviction trade. The second 10% only enters the market when my first position shows a 10% profit. This creates a cascading effect of capital deployment that protects me from catastrophic loss. I learned this approach after the 1929 crash. I had correctly anticipated the collapse and made $100 million shorting the market. But by 1934, I had lost it all again. The painful lesson taught me that entry and exit points mean nothing without proper position sizing. My formula has three critical components that most traders completely miss. First, I scale my position size based on recent performance. After a losing streak, I cut my standard position size in half. After a winning streak, I allow myself to gradually increase position size, but never exceeding my 10% rule. This automatic adjustment prevents emotional decisions during drawdowns. Second, I maintain a mathematical relationship between stop losses and position sizes. If I want a wider stop, I take a smaller position. My exact formula: position size, success, capital X risk percentage, sus, entry price, stop price. This ensures that each position risks precisely the same amount of capital, regardless of volatility. Third, and this is crucial, I use a geometric progression for taking profits. I take 1/3 of my position off at 25% profit, another 1/3 at 50% profit, and let the final 1/3 run with a trailing stop. This approach has saved me countless times when markets reverse suddenly. In 1907, I made $3 million shorting Union Pacific, but lost it all the next year because I abandoned this system. I became overconfident. Remember this: the market can remain irrational longer than you can remain solvent. My formula ensures you survive long enough to be right. Most traders focus entirely on entry signals and market analysis. I did too, early in my career. But I've found that a mediocre trader with excellent money management will outperform a brilliant analyst who manages money poorly. My biggest losses always came when I abandoned my formula. This system isn't exciting. It won't make you rich overnight, but it prevented me from going completely broke during my worst periods. Master this formula, and you'll outlast 95% of traders who blow up their accounts within 5 years. Remember, in trading, survival comes before success. I am Jesse Livermore, and I made $100 million in the 1929 crash, when most lost everything. That's not bragging. It's mathematics. What I'm about to teach you saved my fortune while others jump from windows. This isn't theory. It's the exact method I've used to execute what many call the greatest trade of the century. The market gives clear warnings before it collapses. I saw them all in 1929, just as I've seen them in every major crash since 1907. By September 1929, I had positioned myself heavily short, betting against a market that everyone else worshipped. While newspapers trumpeted endless prosperity, I observed the divergences that always precede disaster. Here's exactly what I saw. First, the market's advance became narrower, fewer stocks making new highs while the indices still climbed. I watched utilities and railroads begin to falter while industrials still pushed higher. This divergence is the market's early warning system. I've never seen a major crash that wasn't preceded by this pattern. Second, I noticed trading volume declining on rallies, but expanding on declines, the footprints of smart money quietly exiting. The public never sees this. They're too busy buying the dips and believing in permanent prosperity. I've learned that when volume patterns shift, the professionals are repositioning before the amateurs even sense danger. My third observation was the most telling. Blue chip stocks began to weaken. When market leaders start failing to make new highs, the bull market is exhausted. By October 1929, I had built a massive short position. I wasn't guessing. I was reading the market's own signals. When Black Thursday hit on October 24th, I was ready. While bankers and industrialists frantically bought to prop up prices, I held my shorts. I knew their efforts would fail because the market itself was telling me so. The following Tuesday, the real collapse began. As the Dow plummeted 12% in a single day, my positions exploded in value. The key to my success wasn't just identifying the crash. It was having the discipline to act on what I saw, rather than what I hoped. Most traders in 1929 couldn't believe the bull market could end, so they ignored every warning sign. Their emotional attachment to the boom destroyed them. I've learned through multiple market cycles that the crowd is always wrong at extremes. When everyone believes markets can only rise, I become most cautious. When panic selling grips the street, I look for value. This contrarian approach isn't about being stubborn. It's about recognizing that markets move on emotion in the short term, but reality in the long term. My greatest trade wasn't just about making money. It was about surviving to trade another day. While I took enormous profits in 1929, I also preserved capital that allowed me to continue operating when most were wiped out. Remember this, in trading, your first job isn't profit, it's survival. The patterns I recognized in 1929 repeat in every cycle. Learn to see them, have the courage to act on them, and the discipline to manage risk. Do this, and you won't just survive market crashes. You'll thrive in them, just as I did in the greatest crash in market history. I am Jesse Livermore, and I discovered early in my trading career that price alone tells only half the story. Volume, the hidden force behind price movements, reveals the true strength of any market move. While others fixated solely on price patterns, I developed a volume analysis system that allowed me to see what was really happening beneath the surface. When I made my legendary trades during the panic of 1907 and the crash of 1929, I wasn't just looking at price charts. I was studying the volume patterns that telegraphed major market turns before they happened. Let me teach you exactly how I analyze volume to anticipate market moves before the crowd. First, I look for a volume confirmation. When I see a stock making new highs, I immediately check if volume is expanding. If prices rise but volume decreases, I become instantly suspicious. I've learned through painful losses that price movements without volume support are like buildings without foundations. They eventually collapse. During the 1929 crash, I observed declining volume on rallies for months before the collapse. This divergence was my early warning system. Second, I pay particular attention to climactic volume. Those days when trading activity explodes to multiples of the average. I've found these volume spikes often mark exhaustion points. In 1907, when panic selling reached its peak, I saw volume surge to unprecedented levels. That's precisely when I began buying, when everyone else was desperately selling. The massive volume told me the weak hands had finally capitulated. Third, I track relative volume across sectors. When I traded cotton futures in my early days, I noticed that volume often shifted between related commodities before price followed. I apply the same principle to stock sectors today. If banking stocks show increasing volume while technology stocks show decreasing volume, I know a sector rotation is likely underway before most traders recognize it. My most powerful volume technique involves identifying what I call smart money footprints. When a stock trades sideways for weeks with gradually increasing volume, I know accumulation is taking place. The professionals, the smart money, are quietly building positions. I've made millions by identifying these patterns before breakouts occur. I remember in 1923, I watched United States steel trade in a narrow range for weeks, but with steadily increasing volume. Most traders ignored this sideways action, focusing instead on more volatile stocks. But I recognized the accumulation pattern and established a substantial position. When the stock finally broke out, I was already fully invested and captured the entire move. Volume analysis isn't merely about quantity, it's about the quality of the volume and what it tells you about supply and demand. I've spent decades refining these techniques through bull and bear markets alike. The patterns repeat because human psychology never changes. Master this hidden force of volume analysis as I have, and you'll see market movements that remain invisible to most traders. Price tells you what has happened, but volume tells you what will happen next. This isn't just theory. It's how I made my fortune. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. Today, I'm going to share my pivot point method, the mathematical edge that helped me accumulate over $100 million in today's money during an era when most people struggled to put food on their tables. The market speaks a language of pivots, critical price points where the entire sentiment shifts. I discovered this pattern after years of watching ticker tape, observing how certain price levels acted as magnets, repelling or attracting further movement. My pivot point method isn't mystical, it's mathematical. Here's exactly how I identify these pivots. I look for a stock that makes a new high after a period of consolidation. When this occurs, I mark that price. If the stock then retreats but later exceeds that marked price, I buy immediately. This isn't guesswork. It's a confirmation that the market sentiment has fundamentally changed. I applied this during the panic of 1907 when Union Pacific broke through its previous high of 163 after weeks of sideways movement. While others were paralyzed with fear, I recognized this pivot and established a substantial long position. Within 3 months, my position had doubled in value. The reverse applies for short positions. When a stock makes a new low, retreats upward, but then breaks below that low again. That's my signal to sell short. The mathematics of market psychology are revealing themselves at these moments. What most traders miss is the discipline required. I don't just identify pivots. I wait for confirmation. I've watched countless men ruin themselves by anticipating breakouts rather than responding to them. Patience is your greatest ally. Impatience, your most dangerous enemy. My method demands meticulous record keeping. I tracked every significant high and low across dozens of stocks daily. In your modern era, you have computers for this. I had to do it by hand. But the principle remains unchanged. The market leaves footprints if you know how to read them. The beauty of pivot points is their universal application. I've used them in stocks, commodities, and currencies. The mathematics of crowd psychology doesn't change across markets. Fear and greed manifest in identical patterns regardless of what's being traded. I've taught you my mathematical edge, but understand this. Knowing my method and applying it are entirely different matters. Most who hear these words will nod in agreement, but fail in execution. The difference between success and failure isn't knowledge, it's discipline. Remember, the pivot isn't just a price point. It's a mathematical confirmation of a psychological shift in the market. When you trade pivots, you're not predicting the future. You're responding to the present with statistical advantage. I promised to teach you my mathematical edge, and I've delivered. This method helped me extract millions from the market when others were being crushed. Use it wisely, trade it with discipline, and you might, just might, avoid the devastating losses that punctuated my own career. The market doesn't forgive those who ignore its mathematics, no matter how convincing their theories might sound. I am Jesse Livermore, and after decades in the markets, I've learned that trading is 80% psychological and only 20% methodological. I've made and lost fortunes multiple times, not because my strategies were flawed, but because my mind betrayed me. Today, I'll share my psychological framework that ultimately helped me maintain discipline through the market's most challenging moments. When I first entered the markets as a young man posting stock quotes at Payne Weber in Boston, I thought success was simply about finding the right patterns. I was wrong. After my first million, I lost it all. After my second fortune, I lost it again. The pattern became painfully clear. My greatest enemy wasn't the market, but myself. I developed a psychological framework that saved me from complete destruction. First, I learned to treat fear and greed as signals, not commands. When I feel the cold sweat of fear telling me to liquidate a position, I don't immediately act. Instead, I step back and ask, is this fear based on market conditions or my emotional state? I've trained myself to recognize when my emotions are trying to override my system. My second principle is what I call emotional accounting. I keep a detailed trading journal, not just of my trades, but of my emotional state before, during, and after each decision. When I lost my second fortune in the crash of 1907, I noticed a pattern in my journal. Every major loss was preceded by the same emotional signatures: overconfidence, dismissal of contrary evidence, and an unusual level of excitement. By documenting these states, I created an early warning system for myself. The third element of my framework is deliberate isolation during trading hours. I've learned that the opinions of others, even well-meaning friends or respected analysts, contaminate my judgment. When I made my greatest trades, like shorting the market before the 1929 crash that earned me over $100 million in today's dollars, I did so from a position of calculated solitude. I refuse to listen to tips, rumors, or market gossip when I'm actively trading. Fourth, I practice what I call consequence visualization. Before entering any significant position, I vividly imagine the worst possible outcome, not just financially, but emotionally. I ask myself, can I handle losing everything on this trade without breaking my rules afterward? If the answer is no, I reduce my position size until the answer becomes yes. Finally, I've learned to separate my identity from my performance. My net worth is not my self-worth. This distinction has saved me from the psychological death spiral that claims so many traders. When I lost my entire fortune in the 1915 cotton market, I didn't see myself as a failure. I saw myself as a trader who made a specific error in judgment that could be corrected. Remember this: the market will test not just your strategy, but your psychological fortitude. Your ability to maintain discipline amid uncertainty, fear, and greed will determine your longevity. I've survived for decades, not because I'm smarter than others, but because I've mastered the battlefield of my own mind. master yours, and you'll have an edge that no market condition can take from you.